Welcome to the latest episode of the In-Basin Observations podcast. I'm Bill Austin with Daniel Energy Partners. Today we are joined by Jason Downie of Tailwater Capital. Tailwater has built one of the more differentiated private equity investment platforms in the market with exposure across midstream, water, infrastructure, water recycling, software, power-linked assets, and upstream through Tailwater E&P. At a time when many investors narrowed focus, Tailwater expanded into businesses tied directly to major structural shifts in U.S. energy. We're going to spend some time today on three macro themes. Number one, the rapidly evolving upstream landscape. Two, natural gas infrastructure bottlenecks. And three, rising power demand, and how those themes create growth opportunities across the Tailwater portfolio. Jason, thanks for joining us here today.
Happy to be here, Bill.
So, for listeners less familiar with Tailwater, how would you describe the firm today? And then just tell us a little bit about yourself so we can get this thing started.
Okay. Well, I'll start with myself. So I'm actually a native Houstonian, grew up in Houston,
Nice.
Went to University of Texas, and then went into banking, DLJ.
Nice.
That was great. Spent some time in Dallas, spent some time in New York, and then went back to business school at UT. I kind of bleed burnt orange. All my Aggie friends in the industry don't like that. But got me back to Texas, which is great. And then ultimately from business school, it was kind of a late 90s. Private equity was really starting to grow.
Yep.
And I went to Hicks Muse, which was a generalist private equity firm based in Dallas. I spent 14 years there, but that's where I met Edward Herring, who is my co-founding partner at Tailwater. And the last, sort of 10 years there, we were only doing energy things. And we were doing a little bit of midstream and a little bit of operated upstream, sort of more traditional private equity, backing teams on both sides. And that was really attacking the natural overlap that exists between those two industries, right? Your reserves aren't worth anything if you can't get them to market.
Right.
And your pipelines aren't worth anything without reserves on them.
Yep.
And not necessarily same skill sets. And so oftentimes you found an opportunity to create solutions in that overlap. And I'm going to come back to that when we talk about Tailwater. So, and then in December of 2012, we decided to spin out and start Tailwater, focusing exclusively on energy.
Okay.
And what I will tell you about our strategy that's a little differentiated, and I think we were a little early.
Yep.
But being middle market, the driver here was about capital intensity and how to actually attack that space in a way that made the most sense. And from our perspective as a firm, we just want to be good decision makers. And so, the one of the best ways to help, amplify that process is to have real data.
Yeah.
And you don't get real E&P production profile data from the public market.
Right.
We all know they report well, but there's just some there's
disconnects.
There's disconnects.
Yeah.
And so if you're actually in the wellbore getting that real production information, real drilling and completion CapEx, and design, that is helpful context for really understanding not only break evens, but also what's coming out of the wellbore, how much gas, how much crude, how much water, et cetera.
Right.
And so, but we didn't want to back teams to do that. So when we intentionally started Tailwater, in order to be in a position to really fundamentally make good decisions on midstream, we also started a non-op business. Okay. And so that was early, back in 2013, basically.
Yep.
We had a fund set up to do both infrastructure broadly and energy, and then we were doing non-op. And because we like the shale returns.
Right.
And what we actually found in evolving on that was it put us in a real position to not only have real information, and I'll get back to 14 years later where we've underwritten 150,000 wellbores. We've participated in 15,000. We have over 300 operator relationships. We have over 3 million acres dedicated to midstream and upstream together, right? So we are seeing a lot of information. Every day we're getting more daily information. And with the rise of computing and AI, it's become even more powerful, right? But the flip side of that is we're not competing with our customers.
Yeah.
So I think maybe early on there was a little bit of anxiety around that, like really, your private equity. But now 14 years in, we've kind of got a real proof track record of how do we help you, producer, solve a problem. And we can bring drilling capital to the table. We can bring infrastructure capital to the table. And when you're really creating a situation where someone has, and it's a bottleneck, it's a capacity constraint. That's this industry. If you're really solving a problem, you can create a contract that's a win-win. The other thing we did that was a little different about tailwater, and we've since evolved one step further and added a royalties component to that.
Yeah, the mineral, yeah.
So we're doing minerals and royalties. So that's the full value suite, and we want to keep evolving over time. We think there's some other verticals we can add, but the other thing that we try to do, we call it full immersion, that I think is differentiated relative to maybe how some of our peers approach the market, is you have to understand the entire value chain. It is all interconnected on some level. It may not be first-degree correlation, but it's second or third-degree correlation. And if you don't understand how all that works, our opinion is you can, one, either make a bad decision, bad investment, bad valuation, bad profile on long-term predictability of cash flow, or you're not kind of skating where the puck's going. You're not you're not seeing the opportunities kind of before they show up. And that, when you're talking about solutions and solving problems, that's really what we're trying to do. And so as we've evolved on that, everything you'll see, like you said, you mentioned water recycling. I mean, these are tangential things, right? We would call that byproduct management.
Okay. All right.
We're doing a used motor oil recycling business in the Gulf Coast. We're doing some carbon capture. We're now doing some behind the meter power. We're doing local, last mile delivery of gas, and all of that stuff is around sort of skating where the puck is going. We're just trying to find areas where we see either a bottleneck or an economic, disparity that we think capital. So I'm going to say it this way: capital around a fixed asset. That is performing some form of fee-for-service business model, where you can do that with a long-term contract with a creditworthy counterparty. So you put all that together, and that's sort of your box, and and then you're finding ways to expand that across the energy value chain. Because
there are other, just like you said, again, starting on the E&P side or even non-op side, there are lots of those boxes off to the side that you just got to go and find.
Saltwater disposal, recycling. We went into used motor oil recycling. Our Shell is our partner in that business. That's an interesting one because, all base oil manufacturing and a lot of chemical, and refined products are being impacted by the current situation in the Middle East. And, it's a good place to be right now because spreads are kind of blowing up. But all of that was just picking opportunities to find ways to debottleneck. I would still say the core business is still traditional gathering, processing, storage, transmission, but we're not afraid to look around the byproduct management side of the business.
And then, so before we get into this other big kind of macro, the themes I mentioned earlier, what do traditional energy investors still miss about the tailwater model today?
That's a great question. I think, what I think is happening is it's changing so quickly. Let's just go through that same evolution of
12 to 26.
We had what I would call Shale 2.0, where they were growing reserves at all costs. And, public E&P was outspending cash flow by 300%. Just
unsustainable.
Unsustainable. To COVID, where the world just kind of went upside down for a minute, but we also had this very big push into fossil fuels are bad. Capital flight from the industry. ESG world, and we're going to pretend like we can replace all this stuff.
We don't need traditional energy anymore.
And it was pretend. It was pretend world. But if you had said to me 7 years ago that the Magnificent Seven were going to, forget about Russia, Ukraine, forget about the Middle East, where I think people got very focused on real supply demand and who is my counterparty. So that I'm going to come back to that. But people were forgetting that energy density is real.
That's right.
Reliability and affordability matter
a lot. And energy security too. We'll talk about that.
And but the push to AI and power generation, way beyond electric vehicles, happened so quickly.
It did.
And they realized gas is an answer that's going to solve the problem. And had to push into that. And I think it really helped. I don't know if the public opinion is there all the way, but I know that institutional investors understand the value and this sort of arms race of AI is very real, and we need to be supporting it with capital. And therefore, however we need to get power to it makes. And so you put all that together, and what makes us, I think, the secret sauce of Tailwater is we have been from day one very fundamentally focused on data and research, and backing teams that have not only core industry expertise, but also core basin expertise.
Yeah.
Right. It's very different. You can't just because you know what to do and
in the Permian versus
doesn't
Mid-Con.
right.
Yeah.
That's not the same, and gas and oil is not necessarily the same. And so, and being in a position to also have those same teams understand how to buy cash flow and optimize it versus build it from greenfield, because again, those are two very different risk profiles. And so you want to be, it's a cyclical industry, in a position to kind of optimize all that. And so what I think some of the traditional market missed was, one, how really I truly think they missed this, how fundamental, physical, conventional energy is.
Yep.
And so I feel like there's a re-rating on that happening right now.
Yep.
And then I think they continue to miss sort of the capital intensity and complexity of the industry. It's certainly not simple. We're not making, it's a manufacturing game, but it's subsurface, right? You're not making widgets.
It's funny you say that. Like, again, this is something that the DEP team has been talking about, again, probably since our founding, that the misrating of traditional energy from 2020 since our founding to today. And I think that you've also kind of hit on a couple of the big macro things that have happened in the last now 6 years, but those have brought those institutional investors back to traditional energy and saying, wait a second, all of these things matter, and we need to be bringing capital back in a responsible manner, not into Shale 2.0 manner, back into the space.
Yeah, and that's the exciting part too, because that did change. Like COVID actually did fundamentally change. If you look at the average C-suite,
yes, we did do this at some point.
Incentive programs.
Right.
Growing reserves was like top of the list. That is not top of the list anymore. It's
returning
still
cash or creating cash.
ROE, return on equity, and balance sheet stability. And it's not surprising that when you change that incentive structure, it radically changes. But I also think, in hindsight, all these management teams are correctly looking at this, going, this is a much better way to run a business. Gives us way more flexibility to, like right now, you don't see rigs, screaming back up because they have the balance sheets to sit here and go, okay, great, prices are up, but are they really up?
Right.
What's the real sustainability of this?
And this is one of those things I like to say, like, some of the other podcasts do this too, but we're saying this at the end of April of 2026. Things change a lot, but that discipline and that the way of looking at things has changed pretty much diametrically from pre-COVID to, today.
Yeah. And I think that's super healthy.
Yes.
Right? And I think that's another thing investors are just now coming back to and realizing. Ian, energy is still 4-ish, it's a little bit below percent of the S&P.
The S&P probably,
and so, which
has been pretty dramatic change even this year, just up.
Yeah, the low was 2.5 or something.
I think that's right around that.
But 20 years ago, 15%. It's super under invested.
Mm-hmm.
And I think investors miss that too. I don't think the average investor understands globally that it is a depleting asset.
Right.
And if you're not reinvesting
in that asset, it is going to make that depletion more difficult to get back.
Correct. So it's fundamental for us, but I think investors miss that. Right?
Yep. All right, so let's hit on the 3 macro trends. Yep. I think we're already touching on this, rapidly evolving upstream landscape, but let's go a little bit more deeply into that on the. Okay, all these E&P operators have gotten way more efficient. You guys are a part of that. The inventory is maturing. Demand still needs supply. We're seeing that, with what we're seeing in the geopolitical world right now. How do you frame that balance? And then again, maybe as a secondary question, where do you think U.S. shale is being kind of underestimated in that whole little thing?
Yeah, boy, that's a
lot there.
That's a lot. That's a big question.
So a little bit too much there,
but not really. I'll let's just come up again with some anecdotes, because this for me is the the easy way to understand like how dramatic some of this stuff is. So in 2023, okay, 3 years ago, I think, and this may just be the Permian, but like something like 40% of wells completed were greater than 3 mile laterals. 60% were still under 3 or more like 2. If you flash forward to last year, 80% of completions were over 3 miles, and 48 or so percent were over 4 miles.
It seems like everyone's breaking a new record.
I mean, it is astonishing speed to fundamentally change that. And so what we saw is that increased IRRs by somewhere between 90 and 100%. And it was only at 40 to 60% more CapEx.
Yeah.
And so that's why you look at production growing with rigs flat. I mean, it's just an amazing...
Rigs flat to down.
Yeah,
or considerably down.
Correct, right. And so you start unpacking that, and that's all U.S. technology evolution. We think that type of opportunity set continues, and we don't think that maybe it slows, but it's not. It's what makes this resource here in the United States so interesting and compelling, and that is also unpacking more zones. Like the Permian continues to be like it's the biggest layer cake of all time, right? And you don't have that, but just go back to the Bakken. People said the Bakken was going to die. Right.
And it has not.
It has not. And in fact, it is growing again. And now there's a whole recompletion, set of activity that's happening. And, so I think that, I do think that inventory is getting clearly drilled. I do think we are creating more new inventory that is better than and bigger than people think.
Right.
But I also believe that, Tier 2 is going to get, we're going to hit all that stuff. It's going to take sustained price to do that.
Right.
Do I think we can repeat what we did from 2010 to 2025, which was what the United States was 90% of the supply side of the demand growth that the globe had? I mean, we artificially kept energy prices
low for
relative to inflation.
For a considerable amount of time.
Yeah, and I wish that's like something I think the industry should be really proud of, and people don't really talk about. I mean, it was a huge boost to the global economy.
It was, and that's one of the, we could go on our soapboxes about how great that is. It is this industry has had a tough time promoting the positives that come out of it, but it's true. I mean, you look at it on a inflation adjusted, people are paying a lot less for lack of a better term, for their gas in their cars than they were, 10, 20 years ago.
Yeah, I think if you did inflation adjusted to 25, crude should have been at 96, right? And we were not at 96.
Not prior to this, that's right.
But that's just so just kind of following through on that. We're still very short cycle reserves.
Right.
We have now consolidated, right? So we have big balance sheets and scale in core basins, which I think makes it harder for private equity on some level, but on the other side, I also think it allows for that technology and evolution to continue to happen at a more rapid pace, and you're controlling more of the food chain when you do that. And so our perspective is the U.S. is going to lead. The other exciting part about it, and we don't talk about it, is we're the cleanest producer of energy in the world, and so that's something I know when I talk to industry CEOs. Everyone's proud of it. They're all focused on it in the boardroom. And so I think we just have an opportunity to lead and continue to show, the innovation that the U.S. can bring to the table, but also being a best-in-class kind of example.
Yeah.
So,
well, best-in-class operator of these assets, right? Yeah. And so I guess from that perspective, this evolving landscape, we've talked a lot about tailwater E&P. That benefits a lot from this. Some of your other portfolio companies, as they play in this, where do they benefit from this continuing evolving landscape?
Yeah, that's a great question. So, if you think about so obviously we are all over the so surprisingly, maybe not surprisingly, the back end of only reinvesting 60% of your cash flow into the drill bit and either deleveraging or buying shares or paying dividends with the rest is that there is still a lot of need for third-party capital in this industry. And so the non-op side of our business is flourishing on the back of that. I will say it's tactically becoming, more relevant to not just bring capital to the table, but bring something else.
Yep.
And
okay.
So in some cases that's information and data. In some cases that's a midstream solution, right?
Yep.
And so where we sit right now, I'll kind of go across the portfolio. We try not to have too many teams competing in
in the same space.
So we have a team that's basically building gathering and processing in the Permian Basin.
Yep.
That's producers midstream, and they are materially benefiting from the continued execution on with core customers in that basin.
Yeah, keeping the pipes full.
We and so we're just going to do that. That's a treating, gathering, processing, and then downstream transmission. We don't have long haul pipe, but so what are we seeing in the Permian? The challenge right now is it's constrained on gas.
Right.
Waha's trading at either low prices or negative prices.
Yeah, I know. I think it might have even been this morning that they were saying something about negative prices again. I was like, oof.
So that's impacting.
Yep.
That's part of the lack of response to these higher crude prices in the front end of the curve is, they can't get their gas to market.
Right.
So, and so we're working on that. We have an investment in public company, Summit Midstream.
Okay.
That business has assets in the Permian as well, and it's more residue pipe transmission. It's called Double E.
Okay.
But we also have assets in the DJ Basin and in the Bakken and in the Arkoma, and so we're trying to use that platform to continue to aggregate and scale in those basins. We have a last mile business, so it's called WTG Energy. So that business, we saw Texas as a huge opportunity for delivering gas to the market for power gen, for residential and industrial, and for human beings.
Okay.
Just because the population in the state of Texas is supposed to double by 2050.
It's still growing like crazy. Yep.
And we were starting to see this while we were looking at LNG, so supply the market, this structural demand pull happening in the gas market.
Yep.
And AI amplified that in a big way. So we were seeing the electrification of everything. We were seeing LNG export.
Yeah.
But AI was so that last mile business has benefited from that because we were looking at delivering gas to industrial users and more like residential power delivery. And now we've had an opportunity to deliver gas to behind the meter power generation. And so that's a big, beneficiary of this power boom. We have a business that's working on LNG sort of critical function logistics.
Yeah.
They're based in they're Houston and Louisiana, but it's a family-owned business that's been around for 50 years, and we're helping them grow because they have opportunities to sort of last mile solutions all around the bottlenecking that's just happening in LNG. What are we going to do? We're going to take it to 25 BCF of daily export or something. So, those are the kinds of things that we're deploying capital in that we think really fit the macro paradigm well.
Well, and so that you've hit on it a little bit, but I was just going to go to the next macro point is the natural gas bottlenecks, right? I think you've kind of hit on it a little bit, but let's talk a bit more about those constraints that we're seeing and how that. Again, you've touched on this already, but that is a big part of what we're seeing in the overall energy market, this natural gas bottleneck and the demand for natural gas that we need to keep seeing here.
Yeah, so it is really I think it's as exciting a time in U.S.-based energy in a long time. And so, and we haven't even gotten to sort of national security.
Yeah.
Because that's I want to come back to that, but we are seeing, and I think some of this is we're just in the right spot being in the state of Texas.
I think that's right.
Because let's just talk about LNG. So you have two paradigms that are structural demand pull that are totally different than where we were in Shale 1.0 and 2.0. Yep. In Shale 1.0 and 2.0, it was much more supply push constrained.
Yeah.
So look at the Permian. It's exactly like that. Okay, we can't get all the gas to market, so we're having basis differential problems. That's real, but it's much more tied on certain levels to the drill bit and drilling activity.
Right.
That's changing because there's a link between that now and where is that gas going.
Right. The LNG export facilities that have built up now over the past 10, 15 years, we're not there in Shale 2.0 or 1.5.
You look at different research and they will suggest that we're at 17, 18 BCF today on the daily, somewhere in there. It's changing every quarter, but there's FID'd and under construction. It's going to take that to like 27.
Yeah, I think that's the numbers I've been hearing too.
So you know, if you look at, you pick your somewhere between 15 and 20 BCF between now and 2035 of LNG-oriented natural gas demand. You couple that with national security, and you can say, you know what, some of that's probably merchant exposed, but less than it was a quarter ago.
Right.
Because where am I going to get long-term gas supply that I feel comfortable, that I'm going to get access to, that I don't have to worry about, you know, a straight issue.
Right. And you're talking about the rest of not just internal to the North America.
No.
You're talking about the rest of the world.
Our
too.
allies, in theory, should be, and we're seeing that, you know, in the Haynesville. It's interesting. You know, there's been Asian buyers of reserves.
Yep.
And the thought assumption was they were going to, what is that molecule really going all the way?
Oh, yeah, exactly.
And, you know, I was talking to some of our commercial bank friends that are underwriting some of that, and it sounds like 50 to 60% of those molecules are actually going. And so we did some work on that average basis on their sort of reserve purchase, like $2 to $2.50 gas.
Yep.
So they don't really care. It's comparing what is my landed price of gas in Japan if I have to buy it versus how much do I save if I just drill my own reserves.
Which is there's that differential, just like you said, 250 to it is a huge number.
Huge.
Yeah.
So they're just running a rig, and so you know that's just different. So that's just different than where we were 10 years ago, and so this LNG structural demand that gets contracted under 10-year deals is changing how midstream infrastructure gets built and how producers are making decisions on drilling. And
that is. So it's funny, internally we talk about this as well. You know, the short-term natural gas pricing, someone said it internally, and I really like this, is kind of like the weather casino. You know, it could go any which way based on the weather. But that midterm to long term, that is much more constructive today than it has been in a long time.
Yeah, the front month doesn't really explain the gas story.
Right.
And so when you then layer on what we hope to be the case, at least this administration wants that to be the case. I hope future administrations follow suit.
I would hope so as well.
Is reshoring of industrial activity here. And Texas, again, is benefiting big time.
Yep.
Well, that's gas demand. We think that's something like 5 or 6 BCF.
Yep.
Mostly for heating purposes, right? And then you have the electrification of everything. And that was 5 or 6 BCF of demand.
Yep.
And you put that together, and there's your 30 BCF or whatever it is. But what I think is being understated is the AI demand pool.
Yep.
And I fundamentally believe that whatever the pledge is that President Trump had some of those Magnificent Seven sign, which is more about build your own power gen. Mm-hmm. That is really, to me, the right answer. So you don't compete with humans
for that power
and cause rolling brownouts or even blackouts. But right now I know that even the low end of AI is in essence selling their product, their computing power for like $3.50 a kilowatt hour.
Which is again below the price of actually powering it.
Yeah, because you buy off the market, off the grid today, 14 cents. So you're taking something that costs 14 cents and selling it for $3.50.
Yeah.
And I think some of the higher computing models are even higher.
I think they are too.
So they're not that sensitive to electric.
Clearly.
Right? And so that's a really bad paradigm for humans who are very sensitive. Mm-hmm. The difference between 7 cents a kilowatt hour and 25 cents is a big deal.
It's a big deal.
And so I think this moves, and now you got supply chain bottlenecks on power generators, but it's not like it's nuclear. I mean, it's a lot shorter timeline.
So this brings us to the third large one, is the rising power demand.
Yep.
I would say that, again, at DEP, we're not AI experts, but we definitely see this rising power demand. We see a lot of our OFS clients that have gone into this behind the meter power, and there is a boom. There's a lot of supply chain kind of not necessarily interruptions, but just lags. But that is an opportunity that you guys are, looking at right now.
We're trying to exploit that because we have, yes. If you look at small behind the meter power, I'm talking 16 megawatt type units. From an execution perspective, those actually look like large compressors.
Yep. And which is why Caterpillar and all these other companies do really well building
Baker Hughes
things.
has one. Caterpillar's got one.
Yep.
That's something our team knows how to do. Like our midstream guys set compression all the time in that size range, right? So it's not a stretch to say, could we do it?
Yep.
And then we have our midstream businesses that have gas supply, and deliverability stuff. So when you look at, then it goes regional.
Right.
So Texas is a really good place to do
We've kind of hit on Texas as a good place right now, which is true.
But, trying to find ways to deliver that stuff here versus, just pick on somebody, I don't know, Arizona.
Yeah.
It's not that Arizona's not going to get data centers, but they don't have as much gas production, right? So you kind of got to put all these things together. I also think I was at a conference this week that was more around sort of energy poverty globally.
Okay.
So here's what's happening to data centers right now. They're getting the not in my backyard.
Right. The NIMBY aspect.
That nuclear is getting.
Right.
Because I don't know who's pushing the advocacy, against this, but they're going to take all your water, they're going to push up your power prices,
right.
Well, it's unfortunate because if we don't win the AI arms race, this is not a.
It's that question of, is it an existential crisis?
It could be.
And there's the NIMBY world and the more macro world are very much at odds on that. But again, it goes back to, we need more power, we need more of everything. And if you're going to put blockades in front of that, it only increases the price of power at a later date.
That's right. And so you could say, go now and you guys go build all the behind the meter.
Right.
We'll give you a grid interconnect.
Yep.
So you can sell it back if you have spare capacity. And ultimately you optimize this. And I would think all the power producers, generators, should want that, because if you look at how short we are on power generation expectations just relative to population growth.
Yep.
I think you're going to need all of it.
And I think that most of those guys recognize that. I'm not going to speak for anyone, but I think they recognize that it is. Look, we live in a democracy, so people get to say things and try to. But we're in that part of the cycle where we need more of it. We have to figure out ways to make it happen faster, and there are opportunities when you see that timeline.
That's right. And so I get excited about AI only because I think our industry can partner with technology. It's the biggest companies in the world to help solve a problem that is a critical path issue for them. And we can do it quickly, relatively speaking. We should obviously have more nuclear, but that's just not a fast solution.
Right. And I think those technology companies don't understand both, number one, the regulatory environment, and two, actually building things. So partnering with people that actually do both of those things is probably is a smart thing for them.
And it makes sense. And so I just think as an opportunity set for our industry, two things have happened in the last year but the AI boom is further. But how can the energy industry help solve a real critical path issue on one of the most, I would argue it's like the Industrial Revolution 2.0. We don't even really know how impactful it's going to be.
We do not.
But we can see it's going to be. And so that's exciting, and we can play a real role in that. And then two, we touched on it, but this national security existential issue, how much of the 20% of the world's oil that goes through the Strait is going to permanently relocate to buying it from the United States. Not all 20%.
No.
But some piece of it, I think, will. Same for gas.
Yep.
and that's good for us.
I think that's right. And again, and then it's closer to our shores. And then I guess the national security and the energy security issue you've talked about a lot, but I mean, that brings reshoring of industrial back to the United States when you have very low cost of energy for that type of stuff.
And reliable.
Reliable, that's right. So you've got that. You've got a populace here that is very entrepreneurial, that wants to build that type of stuff, generally speaking. So those two things really help you in terms of that macro, bringing people industrial back here and then having that, ability to use energy at a very low cost.
Yeah, relative to the rest of the world. Yeah.
Relative to the rest of the world. So, and we've hit on your three main things, as Tailwater as a whole. Why don't you talk a little bit about, why has private ownership been good for you guys? And then look in 24 months, where, if we come back, bring you back here, what's changed, or what are you going to be happy about at that point? I hope.
Oh my God. Okay. Let's see. Let me start with the second one.
Yeah.
In 24 months, I will be really happy if, just as a country, we have anchored around the fact that we have the resources and the know-how to really lead the world in terms of low-cost energy, AI, whatever we want to call it, arms race, winning the arms race, but also, being in a position to really have an advantage, have a defined advantage that's obvious to what you just said, like reshoring of industrial manufacturing. We need to, as just a nation, replace a lot of middle class job,
right?
That has, and I think we can do some of that if we look at it that way. So that would be great if in 2 years we flash, because that will have meant that there's been a lot of good returns generated by investing. And so going then to the second question, or the first question, which was why private assets? I mean, realistically, it's about two things. It's about speed, right, and control. And so, in a public context, and we have a large investment in a public company, you are on some levels just naturally more constrained by quarter to quarter goalposts, right? And then so therefore doing things like anchor greenfield development that take longer to go from start to cash flow become harder to do.
As a public,
as a public company. So being private allows for you to do more of those things, and so you can be faster to make a decision. You can get in there and execute, and then hopefully you're doing that for a basis that allows for you to sell to a public company. And so what's important, you got to make sure you're doing something strategic. You got to make sure it's complementary to your buyer universe,
right?
And you got to make sure you build it right, like best in class stuff. And so if you can do those things, and those are not easy to find. They're not everywhere. But the good example of that right now is simply building new pipe for gas delivery to power gen and behind the meter power sets. Those are two things that are all going to be anchor greenfield, but should be really strategic, for example.
Nice.
So, yeah.
Well, all right. So anything that I missed here? We're kind of winding down. We'd like to keep it right around 35, 45 minutes here.
No, I think this is a great conversation. I mean, I wish that I could, wave a magic wand and know what this resolution is with, with what's happening in the Middle East, right? And I think that's not prolonged, high, what I should say, geopolitically inflated oil price is not good for the global economy. So I don't want that. But the flip side of that is, I understand how we got there, but that to me is the biggest sort of macro risk right now, and that we didn't really get into that, and we shouldn't, because we don't know the answer.
Right.
But it is something that we're watching, because I think it's gonna, if it prolongs into the third quarter, I think it's gonna start slowing things down here, and
duration on that is not our friend.
Not our friend.
And what's been an interesting thing with that, again, the two of us aren't solving this. The geopolitical risk premium on the commodities has largely been, diminished.
Yeah, almost zero.
Almost zero, and now it is back. And What that number is, again, I don't know if we end up, we're not figuring that out here today, but it is a number and it's greater than zero. And so that's going to be a difficult thing to get around, especially as a capital allocator.
Yeah, I look at it as an inflation adjusted metric. So again, going back to it, it should be 95, 96, 97.
Okay.
And if we have 95, 96, 97, with exceptions of bottlenecked areas like California, where they've done it to themselves on refined products, right? That should put us in a position to not necessarily slow down. 115, 120, forget about it.
Yeah.
But if we go back to 85 or 80,
right,
that's still inflation adjusted, meaningfully below where the rest of the economy has inflated. Mm-hmm. And I think it is, and it allows for better execution on operation from producers, right?
Who've gotten extraordinarily good at that.
So that would be a good outcome.
Yeah.
And that's probably $10, maybe 12 of geopolitical risk premium.
Yeah.
And we should probably, as is evidenced by where we are, we should probably have at least that.
From a tailwater perspective, where do you, what are you most excited about, on your internal portfolio companies?
So we're just excited because we have, as a firm, weathered the storm. Our business model is working. Like we in private equity, it's all about creating a deal funnel, right?
Right.
And the funnel is as healthy as it's ever been. And we are, we didn't plan this. We don't usually get in the market with all three of our funds at the same time. We happen to have hit that cycle, but we are finding access to capital to go execute on these things. And I will just tell you, it is, with the exception of what we just talked about in the Middle East, that volatility, the energy environment domestically is as exciting as we have seen in our careers, honestly. Yeah. And that is the culmination of what we talked about with us being a national security choice and LNG export being real and AI being in a position to
tailwind.
Yeah, it's just, and it's structural. Once it's built, this is 15, 20, 50-year stuff. Right. And that's different from where we were. It feels really good. It's kind of like, what the refining complex has been, right? I mean, it's So we're building some stuff where we can dominate as a country, and it's fundamentally going to change how the energy industry plays a role. And so it's exciting. That part's exciting.
That is exciting. Well, let's end it on that. Jason, thank you very much for coming in.
Happy to
really
be here.
Enjoyed this.
Thank you. Happy to be here. Appreciate it.